Have you ever wondered how these giant, multi-billion-dollar projects actually work on the books? I mean, think about a company building a massive new factory or a power plant. They're spending a mountain of cash on interest payments for years before that project makes a single penny. So how do they handle that? Well, it all comes down to this really fascinating accounting rule, IAS 23. And trust me, it completely changes the story a company tells about its financial health. All right, let's just jump right in with a quick scenario. Imagine your company borrows $100 million, and for 3 solid years, all you're doing is building and paying millions in interest on that loan. So what do? Do you just report these huge losses year after year, or is there a better, smarter way to account for it? Let's dig in. So to make this real, let's create a fictional company. We'll call them FutureGen. Now, FutureGen has just landed a huge loan to build a brand new, state-of-the-art solar farm. It's a fantastic, long-term project, but that huge loan comes with an equally huge problem: massive, ongoing interest payments.
And here is the absolute heart of the problem. If FutureGen just treats that interest like any other business expense, well, their income statement is going to look terrible. You'll see millions in costs and absolutely zero revenue coming in from the farm. If you're an investor just glancing at the numbers, you might think the company is bleeding money, even though it's actually making a huge investment in its future. That's a big problem.
So how do you solve a problem like that? Well, this is where the rulebook comes out. Specifically, International Accounting Standard 23, or IAS 23 for short. This is the global standard that gives companies a much more logical way to handle these exact kinds of borrowing costs.
Now, don't let the accounting jargon scare you. The core principle here is actually pretty simple and, frankly, revolutionary. It basically says that if you borrow money specifically to build a certain kind of big-ticket item, those interest costs aren't just a monthly expense. No, they actually become part of the price tag of the asset itself. Let's break down what that means.
First up, what exactly are borrowing costs? It's not just the interest rate you see in the headlines. The standard is pretty broad. It includes other stuff like loan fees, maybe even some foreign currency differences if you borrowed in another currency. It's basically the whole shebang, the total cost of getting those funds.
Okay, and here's the second key piece of the puzzle, the qualifying asset. This isn't about buying a new delivery truck. This rule is for the big stuff, things that, as the rule says, take a substantial period of time to build. Think manufacturing plants, power facilities, or hey, FutureGen's solar farm. It's a perfect example.
So let's put it all together. Here's the big idea. Instead of letting those interest payments drain your profits every single month, you get to do something called capitalization. It's like this. You add the interest you paid directly to the total value of the solar farm on your financial statements. You're building it into the asset's total cost. It's really no different than adding shipping and handling fees to the price of something you bought online. It's just part of the cost to get it ready.
But, and this is a big but, companies can't just start capitalizing interest willy-nilly. IAS 23 is incredibly strict about the timing. You have to think of it like there's a capitalization clock, and you have to know exactly when you're allowed to start it, when you might have to pause it, and crucially, when you have to stop it.
This whole process has 3 main phases. You have commencement, which is when you can finally start adding those interest costs to the asset's value. Then there's suspension, which is for when things, grind to a halt. And finally, there's cessation. That's when the project's done and the clock stops for good.
So when can you start that clock? Well, here's the deal. You can't start it just because the loan money hit your bank account. Nope. You have to meet all 3 of these conditions. You have to be spending money on the asset, you have to actually be incurring borrowing costs, and you have to be actively working on the project. That could be pouring concrete, or it could be the less glamorous stuff like getting permits. All 3 have to be happening.
Okay, but let's throw a wrench in the works. Real-world projects hit snags, right? What if FutureGen's solar farm construction just stops for 6 months because of a big supply chain mess? Well, during that extended period of inactivity, the rules say you have to pause the clock. Any interest FutureGen pays during that major delay, that has to be treated as a normal expense. You can't add it to the solar farm's value.
And finally, when does it all end? When do you stop capitalizing? The rule says you have to stop when the asset is substantially complete. What that really means is the solar farm is pretty much ready to go. It's ready to start generating power, even if you still have some minor paperwork or final touches left to do. The main work is done, so the clock stops.
Now, how do you figure out the exact dollar amount to capitalize? Well, there are 2 paths. If you took out a loan specifically for the solar farm, it's easy. You just capitalize the actual interest you paid on that loan. But what if FutureGen just used money from its general corporate funds? Just a big pot of money from different sources. Well, then it gets a bit more complicated. You have to calculate a special capitalization rate, which is basically the weighted average interest rate of all your company's borrowings, and apply that to the money you spent on the project.
Okay, so we've been through all the rules, when to start, when to stop, but let's get to the payoff. Why does any of this actually matter? Well, let's take a look at how this one little accounting choice completely rewrites FutureGen's financial story. And this right here shows you everything. Look at the two scenarios after 3 years. On the left, if they just expense the interest, their assets are worth $100 million, but their net income is negative. They look unprofitable. But now, look at the right. By using IAS 23 and capitalizing, let's say $15 million in interest, two amazing things happen. First, their net income is at break-even, no big losses. And second, the solar farm is now on their books for $115 million, which is a much truer reflection of what it actually cost to build. It's a night and day difference.
So what's the bottom line here? First, capitalizing these costs gives everyone a much more honest picture of the total cost to get a major asset up and running. Second, it stops us from unfairly penalizing companies that are making these huge long-term investments by making them look unprofitable. And third, it has a direct and massive impact on some of the most important numbers in finance, a company's reported profit and the value of its assets. And so, I want to leave you with this final thought. On one hand, this rule is designed to create a more accurate, a truer financial picture. But on the other hand, by moving a cost from the income statement over to the balance sheet, it absolutely has the effect of making short-term profits look better. So it raises this really fascinating question. Where is the fine line between accurate accounting and just trying to make the numbers look good? It's something every single investor needs to think about.